A single phone call in Beijing shattered the silence, a sound louder than any siren tearing through the chaos of Wall Street. No press conferences, no headlines screaming from every screen. Just one brutal, uncompromising order: stop buying dollars. 48 hours later, Spain signed a groundbreaking deal with China, a pact so profound it threatens to fracture NATO's economic backbone. If you think this is just a trade spat, you're already steps behind. 5 moves back at least. On April 7th, behind locked doors and swallowed by a heavy cloak of secrecy, Beijing gave a chilling command to its state-owned banks: immediately halt all purchases of US dollars. Sources inside the People's Bank of China confirmed this wasn't a gesture. It was a declaration, ready for execution. ICBC, Bank of China, Agricultural Bank, all echoed the same mandate: slash dollar exposure, reroute settlements into yuan, freeze dollar liquidity. This was no experiment. This was Act 1, launched without warning. The timing was precise. Just 2 days after President Trump ramped up tariffs, and barely a week after US Treasury yields soared to levels unseen in years, shaking global markets. Now, a question reverberates through the halls of power in Washington. Is China dismantling the dollar's dominance, not over decades, but right before our eyes? Wall Street remains divided, consensus elusive, but panic is spreading. Goldman Sachs' Hu Shan delivered a stark warning. A sudden Chinese retreat from dollar demand could ignite global turmoil and crush dollar liquidity. Then the numbers hit hard. In March alone, China sold off a staggering $24.1 billion in US Treasuries, the sharpest monthly sell-off since 2018. This wasn't a subtle hint. It was a calculated, deliberate signal aimed straight at the heart of Washington. Then Spain acted, openly, defiantly. A multi-billion euro strategic pact with China. No consultation with NATO, no nod to Washington. Just signatures and smiles marking a seismic shift. Chinese companies now hold the keys to Spain's vital logistics hubs, green energy projects, and research corridors. Valencia, Bilbao, Algeciras, the largest bilateral investment with China since 2005, all while bypassing EU ratification. Hidden deep in the agreement were golden incentives for Chinese electric vehicle giants, rail system integrators, and rare earth refiners. Why does this matter? Because it didn't happen in a vacuum. 2 days earlier, Trump slapped a 100% tariff on European EVs, accusing China of flooding the EU with subsidized goods. Spain, caught in the crossfire, didn't blink. They chose their side. Former EU Trade Commissioner Cecilia Malmström was blunt. Countries like Spain no longer take alignment with the US for granted. It's all transactional now. And if loyalty is reduced to spreadsheets, what happens when other mid-tier economies start doing the same calculations? On April 6th, Trump suddenly hit pause on a $50 billion tariff salvo targeting Chinese tech and autos. The official story? A diplomatic timeout. The markets told a darker tale. That day, 10-year Treasury yields exploded to 4.81%, levels not seen since before the 2008 financial crisis. Treasury data revealed a mass exodus. Foreign governments dumped $67 billion in US debt in the first quarter of 2025. Leading the retreat were China, Japan, and Saudi Arabia. Morgan Stanley's chief economist fired a warning. If foreign appetite for US debt collapses amid mounting deficits, the system becomes politically toxic and economically unsustainable. So was Trump's tariff delay diplomacy or desperation? Either way, the bond sell-off hasn't stopped. The question grows louder. What happens if America's creditors keep walking away? What backstops remain? Meanwhile, China's trade machine isn't stalling. It's shifting gears, rerouting. March 2025 saw China's exports to the global south surge 42.6% year-over-year. Electronics, EVs, industrial hardware roaring ahead. More provocatively, exports to US allies like Mexico and Spain jumped 18.3% and 21.9%. New tariff-free pathways, silent corridors opening wide. The WTO has raised alarms. Chinese goods are flowing through Vietnam, Cambodia, and Mexico, repackaged, rebranded. US Customs flagged a 23% spike in Vietnamese imports, even as Vietnamese exports to China mysteriously soared. Coincidence? Or a masterstroke of strategy? The world watches, breath held, as the chessboard shifts beneath our feet. Scholar Jennifer Hillman cuts through the noise with brutal clarity. Tariffs aren't crushing Chinese trade. They're simply changing its address, and in some cases, making Beijing more powerful than ever. This isn't just a trade dispute. It's a high-stakes economic war, and the fallout is already rippling through global markets and geopolitics. On April 3rd, China's electric vehicle powerhouse BYD detonated a strategic bombshell. The company unveiled a staggering $10 billion mega project in Valencia. 2 sprawling auto plants, a state-of-the-art battery gigafactory, and a sprawling coastal export terminal with direct shipping lanes to North Africa and the Middle East. This is BYD's largest foreign investment to date, a calculated move with seismic implications. BYD hasn't just outpaced Tesla, they've crushed them for 3 straight quarters in sales. And this new European hub could churn out 800,000 vehicles annually by 2028, threatening to reshape the continent's automotive landscape. Spain's deputy prime minister hailed the project as the engine of Europe's post-carbon future. But beneath the green rhetoric lies a sharper reality. This is a calculated play for strategic leverage. While Washington clings to tariffs and trade barriers, fighting defensive battles, Beijing is quietly rewriting the global economic map, one multi-billion-dollar investment at a time. Europe is no innocent bystander. It is choosing sides. No EU country has rolled out the red carpet for Chinese industrial capital faster than Spain. According to the European Union's latest foreign investment screening report, Madrid slashed regulatory approval times by a staggering 43% in the first quarter of 2025, far outpacing even the most trade-hungry economies in the Bloc. That bold move didn't just raise eyebrows in Brussels, it sent shockwaves through Berlin and Paris. Both capitals remain deeply skeptical of Chinese money, viewing it not only with suspicion, but as a strategic threat. Yet as Europe's power centers hesitate and debate, China is accelerating its push forward. BYD's expansion across Europe comes just as former President Donald Trump reignites the tariff war. This time slapping steep duties on EU auto exports. German automakers, long the crown jewels of Europe's industrial might, suddenly find themselves caught in a vice. On one flank, US tariffs cut into their market share. On the other, Chinese competitors flood the eastern markets with aggressive pricing and massive state-backed support. This is no ordinary competition. This is a deliberate strategy of encirclement. Economic pressure from west and east, squeezing the lifeblood out of established industries. The question no one wants to ask aloud is growing louder behind closed doors. Is China quietly dismantling US and EU trade access? One electric vehicle at a time. On the surface, America's allies nod in unison. They publicly back Washington's hardline trade stance and echo its security concerns. But the reality painted by the numbers beneath the public statements is far murkier and far more alarming. Behind the polished speeches and official communiques, a realignment is already underway. Eurostat reports that imports of Chinese electronics into the EU surged 16.4% in the first quarter of 2025. Not in defiance of US tariffs, but alongside them, quietly reshaping supply chains. Down under, Australia, a stalwart of the Western Alliance, reported a shocking 21.7% spike in lithium exports to China, even as it reaffirms military and intelligence ties with Washington. These aren't accidental policy contradictions. They're systemic fractures threatening to unravel the Western coalition. Consider France's aerospace giant Airbus, once the flagship of transatlantic cooperation. This quarter, Airbus doubled its procurement orders from China, signing $2.3 billion in contracts with AIC, a Chinese state-linked aerospace giant. Japan, a linchpin of US foreign policy in Asia, defied expectations by importing 11.2% more Chinese semiconductors, even as it publicly committed to stricter tech controls. As Wendy Cutler, a former US trade official, told Bloomberg, "Allies are doing what's politically necessary while hedging commercially." The narrative and the numbers are diverging. And if that divergence becomes permanent, the core question isn't who's winning the economic war, but whether the US still holds any real leverage, or only loyalty. Then came the Washington counterpunch on April 6th. The US Treasury blacklisted 12 major Chinese firms, including TTL, a battery giant, and SMEC, a state-affiliated chipmaker. But the blow was far from surgical. Blacklisting these companies means striking at American portfolios too. Morningstar data reveals more than $412 billion in US retirement assets are passively exposed to Chinese equities through index funds managed by giants like BlackRock, Vanguard, and Fidelity. This isn't just a signal of resolve. It triggers a cascading effect of forced liquidations, ETF reshuffles, and surging global market volatility. When Hikvision was blacklisted in January, investors pulled $3.7 billion from emerging markets funds. That pattern is repeating now, with more pressure mounting. FTSE Russell is revising indices. JP Morgan warns of growing strain on emerging market funds. And a leaked SEC risk memo obtained by the Wall Street Journal paints a dire picture. Without structural reforms to domestic investment rules, a disorderly unwind of US-China financial ties could be imminent. This is not a precision strike. It's a shot through the heart of the global financial system. And the tremors are being felt at home. US core inflation hit 4.3% in March 2025, driven by soaring costs for imported electronics, auto parts, and household goods. Yet real wages are flatlining. Average hourly earnings have fallen 0.6% year over year. The purchasing power of ordinary Americans is shrinking. The middle class feels the squeeze like never before. According to the National Federation of Independent Business, 29% of small firms now cite tariffs and input costs as their top concern, up from 8% just a year ago. This isn't isolated pain. The entire economy is under stress. The Institute for Supply Management's manufacturing index plunged to 47.2, the lowest since the 2020 COVID crash. Economist Mohammed El-Arian spoke bluntly on Bloomberg. You can't have simultaneous inflation, weak wage growth, and declining production without risking stagflation. A toxic combination that has plagued economies before and could doom this one. The deeper crisis isn't just political, it's existential. Tariffs may rally the base and signal toughness, but are they economically survivable? What happens when ordinary voters must choose between paying for groceries or gas? When consumer confidence cracks, the fallout is rarely contained. Recession looms, or perhaps something even darker. Foreign confidence is already crumbling. In the first quarter of 2025 alone, foreign holdings of US Treasuries plunged by $138 billion. China offloaded $31.6 billion, its lowest US bond holdings since 2009. Japan pulled back $23.4 billion. Saudi Arabia withdrew another $11.9 billion. These aren't minor portfolio adjustments. They're structural exits, driven by geopolitical risk and currency volatility. And now the consequences are striking at home. The 10-year Treasury yield soared to 4.89% by April 10th, up sharply from 3.91% just 4 months prior. That spike lifts borrowing costs across the board. Mortgages, corporate credit, federal debt, all becoming more expensive. The Congressional Budget Office warns that every 1-point increase in interest rates could tack on $2.2 trillion to the national debt over the next decade. Former IMF economist Desmond Lockman issued a dire warning. If foreign investors flee the US bond market en masse, the Fed may be forced to tighten monetary policy in the middle of a recession, a nightmare cocktail of stagflation and capital flight that could devastate the economy. So here we stand, at the precipice. If bond demand collapses, the dollar weakens, allies hedge their bets, inflation erodes wages, what happens next? Who or what will be left holding the system?